Hey everyone, Luca here with an update on the latest macroeconomic data and the impacts on Fed's policies moving forward. As always, if you enjoy the content, don't forget to give this video a thumbs up and make sure you're subscribed to the channel so you never miss out on future updates like this. Now let's get into it. Alright, so a couple of days ago we've had the inflation data coming out. The CPI year over year came in at 2.4%, which marked a small bounce since the last reading back in April. But we see that this is pretty much the level it has stabilized, around 2%, so this is right around Fed's target. And we see that there have been 3 consecutive readings below 2.5%, which has never happened since 2021. So that is quite big, to see that inflation has durably cooled off. So why are we not seeing rate cuts? Why are we not seeing the Fed officially transitioning away from their quantitative tightening policies and the Fed declaring their victory against inflation? This is the topic we'll discuss today, and we'll go over the potential impacts this may have on the markets as well. So make sure you watch until the end, because this video and this in-depth dive in the macroeconomic environment will be key moving forward. Now, a couple of days ago, we've also had the labor data coming out. And one of the most important things that we want to pay attention to is the average hourly earnings year over year. So this marks the growth rate in wages. The reason why we want to track it is because it's a very important metric for the Fed. Now the Fed wants it to be somewhere in the vicinity of 3%, which we see that isn't a level that has been reached over the last couple of years. Now, of course, when we had that very stable macroeconomic environment from 2010 to 2020, as we see here, the average hourly earnings were around 3%. And then they started to rise back in 2019, and then of course back in 2020 with the pandemic stimulus. But since then, we didn't really have the average hourly earnings going below or around 3%, which is something to think about, because that's where the Fed wants it to be. As long as the average hourly earnings continue to stay high like this, in my opinion, the Fed will keep their cautious stance on inflation reigniting. And we also have some interesting narratives around this, which have been going on over the last couple of days, which are tariffs. Now, tariffs are something that have been in the headlines for many months now. We all know that Trump tends to flip-flop around with these tariff headlines, and that has led to a lot of uncertainty. Now, the reason why the Fed is paying so close attention to these tariff headlines and to all these tariff uncertainties is because tariffs can lead to artificially higher prices, as corporations pass costs to the consumers by raising the prices of particular products impacted by tariffs to keep their profit margins intact. Now, that leads to artificially higher prices and, of course, to higher inflation. But the interesting thing about this is that most of the times tariffs actually become deflationary, because consumers, if they are tapped out, as I said in one of the threads I made a couple of weeks ago, is that if consumers are struggling, then demand would simply drop, which means that if tariffs actually are being implemented, they will lead to a higher inflation on the short term, but will actually lead to deflation on the longer run, because consumers no longer afford to buy those particular products, therefore consumption simply drops, and that leads to a lower inflation. So this is pretty much where the uncertainty currently is for the Fed, how the narratives around tariffs will end up. Because nobody really knows. Not us, not the Fed. As we all know, Trump has been flip-flopping around with these tariffs for weeks and months. So it's not something new under the sun, but it's something that we have to pay attention to. Because, as I said earlier, they will have major impacts on the economy if they will get implemented. Now, there is a second reason why the Fed has been keeping a cautious stance around making any intervention on their monetary policies, and that is the latest geopolitical tensions between Israel and Iran. Now, the reason why we want to pay attention to these geopolitical tensions is because they have a major impact on the oil's price. Since we had these geopolitical tensions, oil's price has spiked by around 30% in a matter of days, which only highlights how important these geopolitical events. Now, when oil's price goes up, most of the times it has a deep impact on inflation as well. So if these geopolitical tensions continue, it could lead to a higher price for oil, which of course would lead to higher inflation, which the Fed is trying to avoid to reignite. The price tends to front run the news. So what the charts are currently telling me is that oil will have a short-term pullback. As we've reached this major resistance range, we've tested it, we see that it has acted as a major reversal point in the past. Each time it got tested, the price has rejected. We see here as well. Now, this resistance range also coincides with a high time frame resistance trend line, which we see has acted as a reversal point in the past as well, which the price has been struggling to break above of, as we see here. So I believe that on the short term, oil will cool off and will have the short term pullback. Now, whether this short term pullback eventually leads to a higher price of oil and then this breakout, which would also imply that the geopolitical tensions between Israel and Iran continue, that would be a bearish scenario, but we need further confirmations in order to say that that is what's going to happen. Now, of course, as we all know, tensions in the Middle East aren't something unusual, and it has been going on for years and years and years. So it's not something uncommon to see these tensions between Israel and Iran or Israel and Gaza and so forth. Now, I don't want to comment on what's going on there, but purely from a technical standpoint, I believe that the tensions will cool off in the next couple of days, and then we'll have more confirmations onto what will follow next. But this is the second reason why I believe the Fed has been so cautious on making any changes in their monetary policies. Now, looking at the CME Fed Watch tool, we see that there is currently a 97% probability of another rate hold in June. Now, looking at the probabilities, we see that the first rate cut is currently priced in September. Now, this has been my base case for many months now. I expected the first rate cut to be somewhere in July or in September. It seems like the markets are currently pricing in that it will be in September. I believe this is a positive indication for the markets. And let me explain to all of you why I believe that. Whenever we have the Fed making any intervention in their monetary policies, it signals that the path that the economy is on isn't sustainable anymore. Therefore, the Fed needs to intervene in order to change the trajectory of the economy. That's what an intervention or any changes in monetary policies implies, that the path that the economy is on isn't sustainable and something needs to change. The fact that we're seeing right now stable monetary policies is a positive indication for the markets, and is something that I believe will lead to higher prices. So let's now move on to the charts and let me show you exactly what I've been tracking. Now, moving to the charts, we have the S&P 500 and the United States interest rate. And what we see here is that all throughout 2023 and 2024, when the Fed had interest rates at the highest levels since the early 2000s, so the highest levels in over 2 decades, while most expected a full-blown recession or an economic downturn because the interest rates were so high, the markets kept on going higher. And the reason why that is very simple in my opinion. Everything comes down to the risk appetite of investors and to how investors perceive the broader markets, the broader macroeconomic environment, and the monetary policies. Whenever monetary policies are stable and easy to predict, it leads to a higher degree of confidence in the markets, which leads to more investments and higher prices. Now, this has been my argument for many weeks now, and this is how I justified the latest reversal in the markets. I believe the next few weeks will bring a lot of confidence and a lot of euphoria. So I believe we're going to repeat something very similar to what we've seen back in 2023 and 2024, when there was all of that confidence and certainty around monetary policies, as they were very easy to predict. It will lead exactly to that same environment. But this time, I expect that the main spotlight will not be on the traditional equities and major indices such as the S&P 500 or NASDAQ or the DJI, but on the risk assets. And I believe that these major indices will enter this complacency phase, this final distribution phase, as liquidity starts flowing into the risk assets. Meanwhile, the Fed will keep holding their interest rates at the same levels, having stable monetary policies that will lead to a higher degree of confidence for investors. And that is a very positive indication that I see not a lot of people have been highlighting. A lot of people seem to be under the impression that rate cuts will be the macro catalyst that will push equity markets and risk assets higher. I disagree. I believe that the environment leading up to rate cuts is the one truly bullish and positive for the markets, as it allows market participants to speculate on the idea of rate cuts, on the idea of the end of quantitative tightening, and that is what fuels the euphoria and risk appetite of investors, which drives the prices of equity markets and risk assets higher. Once again, I believe that rate cuts from a fundamental level aren't something positive for the markets, as it signals that the path that the economy is on isn't sustainable, and that's why the Fed needs to intervene through making a change in their monetary policies. The fact that we're not seeing any changes in their monetary policies implies that the economy is still resilient, is still strong, and that's why they are allowed to keep their monetary policies stable. Now, moving to a post I shared back in early April is around the correlation between the S&P 500 and Bitcoin. Now, at the time, a lot of people were highlighting that the S&P was going down while Bitcoin was very strong, and Bitcoin showed a lot of relative strength against the S&P 500. Now, I've made a post then that in the short term, it didn't really change much. But That divergence was a clue to where liquidity will flow next in the midterm. And that was one of the biggest confluences I've looked at to determine the fact that we didn't top out for this cycle. Now remember, this is when a lot of people were saying that we were entering a recession, that we were in a bear market, that we were never going to recover. This is when Bitcoin's price was around $75,000. And I made this post publicly where I said that we will have this final blow off top and that I was accumulating. Now remember, this is also when I made the post around me having the lowest cash positions since the 2022 bear market lows. And the reason why I'm saying this now is because I believe we're in this complacency phase in equity markets. We've just entered this complacency phase in equity markets. And I believe that this is when the real decoupling will begin between Bitcoin and the S&P 500. Now this phase is marked by a lot of volatility. As we near the cycle top, the volatility will increase and we'll have major swings along the way, both up and down, because that's how market makers will be able to distribute, through a lot of volatility and also by inducing a lot of euphoria. And this is where I think the risk appetite of investors comes into play. This is where I think that these positive narratives around the end of quantitative tightening, or that the fact that we'll have rate cuts coming soon, will come into play. Because everyone will tie themselves to these narratives, and that's how I believe they'll get trapped at the top. Moving to Bitcoin's chart, we have my Elliott wave count, which is looking something similar to this. I believe that we're currently in this corrective wave 2 that eventually precedes this major impulsive wave 3. Now, this all correlates perfectly with my broader thesis around an emotional gap that will form in the coming weeks, which will eventually lead up to this cycle top formation and to this final impulse up. So how this would look like is something very similar to what we've seen back in October, and I've shared this thesis many times before, but I believe it's one of the most important things out there to focus on, this emotional gap thesis and how it plays a role into shaping the market cycle itself. So basically what we've seen in October is the price testing this high time frame resistance range and a lot of disbelief. People not believing that this was the true reversal or that Bitcoin was going to go up from these levels. A lot of people at the time were highlighting the idea that we may be heading lower before eventually we bounce on higher and have this rally in the next couple of weeks. But not a lot of people were saying that this was actually the true breakout until we finally broke out. But remember, what preceded this phase was extreme fear and capitulation. This is where a lot of retail investors have increased their cash positions to prepare themselves for lower prices. And that's where a lot of people have started to say that we were entering a bear market. Very similar to what happened now, back in early April, as you guys remember. Back in August, as well, I was bullish, I was a contrarian to how most felt, and I shared a public update where I said that I believed we bottomed at $49,000, and from then on, we would enter the next impulse up, as you guys can see here. Now, what's important to note about this is the emotional gap that formed in November. This major impulse up, which led to all of the euphoria, as we all remember back in late November and then December, which led up to this distribution phase. This is what I believe will happen in the next couple of weeks as well, right now. We're seeing this corrective wave 2. A lot of people are highlighting the idea that we may be entering a deeper pullback, or that we're gonna have the Q3 weakness kicking in and a prolonged consolidation phase similar to the one we've seen back in 2023. A lot of people have been highlighting correlations with what is currently happening now and what happened back in 2023 when Bitcoin swept this prior high, as you guys can see here. So this was a sweep of the highs, and then we entered basically this prolonged consolidation phase that eventually preceded the actual breakout. And that's what a lot of people have been highlighting over the last couple of days. But I believe that all of this eventually leads up to a very similar emotional gap to the one we've seen back in November, where a lot of people hope for a deeper pullback to buy after increasing their cash positions here, but unfortunately that's not how the markets work. And I believe the markets will simply leave them behind with this major impulsive wave 3 that will actually create an emotional gap. Now, the reason why I believe these emotional gaps form is because that's how market makers have liquidity to trade with. And that's how market makers always have a counterparty. Back in early April, a lot of people were scared and they were panic selling because they thought we were headed lower. That's where market makers were buying. Now, a lot of people don't believe that this is the true reversal, or believe that we're going to have a prolonged consolidation phase or a deeper pullback, and so they are not buying at these levels. They are waiting for clear confirmations that we have bottomed, or once again for a deeper pullback. If the price goes up from these levels, it's because this is where the bullish narratives will start to hit the table. This is where a lot of euphoria will emerge, and that is where market makers will start to distribute. So everything they have accumulated here, this is where they'll start to distribute, and they'll use retail as a counterparty, which didn't buy here because they didn't believe that this was the true reversal, Instead, they'll buy here in the peak euphoria where all the positive narratives come into place, where everyone wants to buy, where nobody believes that we are going lower anymore. This is where you want to sell. I believe that there's a very low likelihood that we're gonna enter a prolonged consolidation phase to the one we've seen back in 2023. So something similar to this that will eventually precede the next move higher. This is not something I exclude for the moment. I believe it's possible, but I think it's very unlikely that we'll see this scenario playing out. And there are many bearish confluences that have to form in order to say that this scenario is likely to play out. So for the moment, I believe that my current bullish thesis, which implies this major move higher, is likely in the coming weeks and months, because it will create this emotional gap, which fits perfectly into my broader market outlook. But I also don't exclude the possibility where we have this prolonged consolidation phase on the midterm that will eventually precede the next breakout. And once again, we have to take the markets level by level. We don't know what will follow next. We don't know how the geopolitical tensions will advance from now on. So the only thing we can actually do in the markets is to adapt to market circumstances and to always be prepared for multiple scenarios to take place. If this scenario plays out, if we break below key support levels, which I'll cover in one of my upcoming videos on Bitcoin specifically, then I'll say that my bullish thesis on the midterm has been invalidated and that we need to prepare ourselves for a deeper pullback in the next couple of weeks before eventually we have this reversal. So with that being said, this is how I interpret the current macro data and Fed's policies moving forward. And this is also why I believe it all leads to a risk-on period in the coming months as we near the cycle top. This has been the video for today. As always, if you enjoyed the content, don't forget to give this video a thumbs up and make sure you're subscribed to the channel so you never miss out on future updates like this. Thank you all for watching, and I'll see you guys in the next one.